Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. Let me start by wishing us all a happy and very prosperous new year going forward. And what I'm going to be talking about here, this particular video is in conjunction with my written article, How You Can Beat the Market Without Fail. And that's a very important discussion because I'm not a believer in trying to beat the market. As I said in the written portion, I'm a believer in trying to meet specific goals, objectives, and in line with the risk tolerances that each individual investor has uniquely and personally to themselves. So let's start by looking at the S&P 500 today. The orange line in this graph would represent a theoretical intrinsic value. The blue line would represent a normal valuation, or the valuation that the market has applied most commonly. I want you to notice that I picked the time frame here since coming out of the Great Recession for a couple of reasons. One is I want you to note that the S&P was below both the orange and blue lines starting out here at the beginning of 2009, or the end of 2008, if you will. And this has been really one of the most remarkable or best performing times in the market's historical performance. If you look at it, the market has averaged 13.4% total return. Growth component alone has been 12%, and it's thrown off about $4,000 in cumulative dividends, all of this based on an original $10,000 investment. So performance-wise, 13% is a very high number for the S&P 500. Historically, that's way above average. Normal is about 6 to 8%. And so we've averaged over 13%. But I do want you to notice that number one is the market currently is trading at a very high valuation relative to historical norms, even through this very strong bull market we've had. The blended PE ratio is currently over 20. And as you can see, there's been plenty of times here where the market was trading at PEs in the 12 and 13 range, in the 15 range, which is the orange line, and then in the blue range, which is about a 16 and a half, or we'll call it a 17 PE ratio. So we've got what I would call on the high end of fair value here. Now, performance-wise, again, we've done double-digit results over 13%. So I've put together a list of 10 companies here, and I'm going to measure them historically. First of all, I'm going to start with AVGO, which does not have a history long enough for me to basically compare it directly to the S&P over that same time frame, but I can compare it to the S&P since August 31st of 2009. And what I want you to notice is a $10,000 investment in Broadcom would have thrown off over $15,000 in dividends, and over this shorter time frame, the S&P would have thrown off about $3,480. The growth component was triple roughly what the S&P was. So here's an example where you've got a capital appreciation potential as well as a significant dividend income advantage. The capital appreciation component is the one that's a little tricky. So let me move on to my next example here, which is Bristol-Myers. And what I want you to notice with Bristol-Myers, if I look at this long-term graph, the company's growth rate has been relatively weak throughout all these years. And again, this is a pharmaceutical company. They've got a lot of new products in the pipeline. And I do want you to notice that expectations are expected to grow dramatically. But if I look at the historical growth since 2009, using that same comparison I originally did to the S&P, you can see the company's grown at 11.58% a year. And when I compare its performance, it underperformed the market. There's that 13 and 12% results the market did. However, it still outperformed the market or produced more dividend income in the market. And that to me is the most predictable thing. Now, we don't have the last quarter of 2019 yet because they haven't reported yet, but this is a pretty accurate comparison here. You've gotten over almost $6,700 worth of dividends versus just a little bit over $4,000 of dividends. Now, going forward, if I'm looking at forecasting, I believe this company is capable of generating about a 12% rate of return. The market, because of its high valuation, and let me actually go back to that because I think it's important. If I go back to the S&P 500 and look at it from a standpoint of forecasting the future, the market is expected to grow at 8.5%. That's still substantially higher than norms, but if it traded at a normal PE, that's about a 5% return, and if it traded at a 16 to 18%, that's about an 8% return. So I've got 5%, 6.5% and 8% as what I would call normal potential that the market can bring. And yet Bristol-Myers now, because it's expected to grow so quickly over the next several years, is looking to grow at 9.4% rate. But because it's fairly valued, the rate of return out here would be double-digit rates, and it ought to be capable of producing significantly more dividend income as well. Now, this next one I want to talk about is Caterpillar, because in the article I talk about looking for companies that have persistent growth. And Caterpillar, as you can see here from the long-term graph, is a very cyclical company. And if I look at it since coming out of the recession, you can see how cyclical it's been. Earnings growth has only averaged 5.6%, but it's been very lumpy, very fast growth. You can see the numbers here at the bottom of the graph, followed by weak earnings for several years, followed by strong growth again. But when I compare performance, what's interesting is even with this cyclical growth rate, because the company is a quality dividend stock, it's increased its dividend every year. And again, I've only got 3 quarters here for 2019 because we don't have the 4th quarter yet, but we're averaging just under 8% dividend growth, and we've produced, again, more dividend income over this great period in the market compared to the S&P 500. So, the one thing that I think is very, very predictable, as I pointed out in the written portion, is the dividends. The dividend line is a very persistent, very consistent, even for the cyclical company. In this case, the earnings line is very erratic, and of course, therefore, so is the price line. But nevertheless, if you get a consistent dividend payer, you can outperform the market over time. Now, Cummins is the diesel manufacturer, is another interesting example. It is what I would call quasi-cyclical, as you can see by the long-term graph and then even by the shorter-term graph. But once again, it was undervalued. It's undervalued today. Its historical performance compared to the market generated substantially more dividend income, and it's substantially higher growth, even though the market had such a great period of time here. This was one of the better stock market performances that I've seen in my almost 50 years of doing this. Now, next I want to go to Omnicom. It's the advertising company. And again, if I look at it, this is a very consistent company, but I do want you to notice it was very overvalued in the beginning of 1999. But if I go back to this time frame where we were comparing it to the S&P, once again, it was undervalued. Growth has been about 6% during this time frame, but because it was undervalued, if I compare the performance of this company to the S&P, once again, I see more dividend income than I would have gotten investing in an index fund. And in this case, I didn't outperform the S&P on capital appreciation, but I, performed well enough to where I had a 12% rate of return instead of a 13% rate of return because I bought a great dividend company when it was undervalued. But the key is I did get this predictable level of dividend income. And that's really what I'm focusing on in this presentation, is that the dividend income is much more predictable than the fleeting stock price. Because if I measured this from undervaluation to overvaluation, my rate of return would be 18% instead of 12%. So valuation is always going to have an impact and an effect on these things. Now, my next example here is Principal Financial Group. It's a financial, and of course, it suffered, through the financial debacle. You can see a tremendous drop in price, and this company also cut their dividend during that time. But if I shorten this time frame again and look at it just from this great market period, it grew about 4.6%. It outproduced the S&P 500 on dividend income once again, but underperformed it on capital growth. But I also want to make a point, even though these stocks are underperforming, if you were a retired investor living off your income, you're getting more dividend income off of this stock than you were the S&P, and your performance is still good. I mean, I would be very happy with 11% per year. Now, going forward, this stock is expected to generate 18% rates of return, whereas I showed you earlier, the S&P only about 5%. So here's a case where we've got decent growth, but we've got that financial leverage I mentioned in the written portion where the PE could expand from just under 10 up to its normal 15. Now, if I did a normal multiple, because this stock trades at a discount, the rate of return would still be just under 18%, but slightly less than it is if I look at it from what I would call a theoretical fair value. The next company I'm going to look at is also in financial services, Prudential Financial Group. And once again, it's a financial, so if I look at it, I want you to notice the blue line here. The market tends to price it at a discount of around 9 or 10 times earnings. It's currently trading at a blended PE of 8.25. But if I look at its historical performance, substantially outperformed the S&P on dividend income, performed close to the S&P but underperformed it on a standpoint of growth, and then the total return was almost a dead heat. It produced just slightly less total return, but again, if you're a retired investor living off the income, you got all this marvelous dividend income here. And I also want to point out that that dividend income was consistently growing, as I talked about in the written portion, regardless of whether these prices are moving up or down. That really doesn't matter. I want to look at another financial here, Royal Bank of Canada. And once again, if I look at this period since the end of 2008, the beginning of 2009, you'll again see a significant advantage over the S&P 500. I've got a little different fiscal year here. I've got an October fiscal year, so I'm not measuring the same time frame you saw in some of these other examples, but it's still close. So here we've outperformed the S&P in dividend income substantially. We've underperformed it on growth, and we've ended up underperforming it on total return. But again, if I was an investor living off the income, I would have done much better owning Royal Bank of Canada than I would the S&P 500 from simply an income perspective. And then this next graph I'm going to look at is Simon Property Group, which is a real estate investment trust. So I need to adjust this graph. I'm going to move to funds from operations, which is how you measure REITs because they're a slightly different animal. And if I look at this company, you see 6.8% growth. The company's undervalued today. It was undervalued at the beginning of the time frame. The current yield is 5.78%. That's a significant advantage over the market's current yield of about 1.85 or so. And once again, we see a substantial outperformance on income. $10,000 would have thrown off over $11,000 in dividends versus, again, only $4,000 in the S&P. Now, capital growth was slightly less than we saw with the S&P, but close. I mean, that's still very good growth performance, but interesting enough, we ended up with an outperformance on total return because of the dividend advantage that this company was able actually to give us. So, there you have it. The idea here is that investing in an index is something that a lot of people say people should do rather than try to beat the market. And my argument is I'm not really trying to beat the market. What I'm trying to do is meet a specific investment objective. And I'm really talking about here investing in dividends. I can very predictably and almost without fail, in fact, so far without fail, generate more dividend income by hand-picking individual dividend growth stocks, especially if I choose from the champions, contenders, and dividend aristocrats and dividend kings, etc. If I'm looking at companies with good dividend records, I've got a very high probability of outperforming the market in general. As long as I start with a higher yield, I've got decent growth and good valuation. Right now, the biggest thing with the 10 stocks that I showed in this portfolio would be the valuation advantage. As I pointed out, the market is moderately overvalued in the aggregate, but here's 10 examples of stocks that weren't. So anyway, I hope you enjoyed this. I appreciate y'all watching the video. And if you like what you saw here and like dividend growth investing, you might want to take a look at the Dividend Kings marketplace service on Seeking Alpha. Thanks for watching.